I'm Julia Byrne. I head up the accounts team within the Entrepreneurial Services, and I'm joined here with Mark Levy, who heads up the Entrepreneurial Audit side. We're here today to talk about the impending changes to FRS 102 and how that's going to affect our clients and what we can do to help. So Mark, what are the changes?
There are two key changes to FRS 102 coming in. The first relates to revenue recognition and the second relates to lease accounting. There are some other changes as well, but they're less significant than revenue and leases.
So what exactly are the changes to the revenue recognition?
Very broadly, the UK accounting standards are aligning with international financial reporting standards. We're bringing in what's called a 5-step model, which is going to require you to look at your contracts and analyse out the different performance obligations and allocate a proper value to each different performance obligation within the contract.
In practical terms, what does that really mean?
Well, most people have already seen this in practice. You may have noticed a few years ago your mobile phone bill started looking different. You used to get one charge, and now that's been split out into its two different components. Firstly, you're getting a charge for actually buying the mobile phone, and secondly, you're getting a charge for the use of the airtime each month. That's the mobile phone companies adopting the changes in international financial reporting standards so they can record the different revenue elements of each contract from the outset.
So each of our clients are going to need to look at their revenue streams, look at their contracts, and understand how all the different changes are going to affect them for the reporting.
Absolutely. It may or may not affect your business, but until you've done the analysis and looked at what each different part of the contract says, you're not going to know whether it's going to impact your numbers or not. And can you tell me about the changes which are being introduced to leases?
Yes, it's a big change. So where we've had office buildings where you have the rent going through the P&L, it's not going to be recorded like that anymore. So we're going to have right of use asset on the balance sheet, and we're going to have the matching liability in the balance sheet as well, but for the whole lease term, not just for the annual amount, which is going to make a massive difference.
So the balance sheet is going to look completely different. You're going to have an asset which didn't exist before and a much larger liability.
Absolutely. It affects the P&L as well.
Yeah, so on the profit and loss account, as you said, the rent charge is no longer going to appear, but instead you're going to have amortization of that right of use asset and the unwinding of a discount of a liability, so you're going to get an interest charge going through the profit and loss account, and that's going to have an impact on your EBITDAR figure.
Exactly. So it makes a huge difference to what people are looking at. So investors, lenders, suppliers, anybody that's looking at the accounts, they're going to look totally different.
And I think it's really important that people have those conversations early with the investors and the bankers, because it could impact covenants, particularly where they're focused in on EBITDAR or targets on EBITDAR, as the EBITDAR figure is going to change.
Exactly that. And for our clients, what we can do is we can help them at an early stage. So for where we're producing the accounts for them, they need to, although it doesn't apply till accounts year end 31st of December 26, it's with effect from the 1st of January. So where they're doing management accounts and want their management accounts to match their financial statements, we need to adopt this really early.
And that's quite important, because if people are looking at the accounts, or you've given those management accounts to investors, they're going to get a shock if suddenly 18 months down the line you're producing the year-end financial statement
and
the numbers,
match.
Yeah, the numbers look totally different. From an audit perspective, clients should start thinking about this now, because you don't want to be finding out that your revenue isn't right when your auditors are coming to look at the information. It's better to get the information right from the outset. And when we come to do the audit after the year end, you're potentially talking at least 12 months previous, if not longer, and it's quite difficult to go back in time and correct the information.
And for the non-audit clients, it's a similar story, you know, that we often don't do their accounts. They need to be submitted 9 months after the year end. Some of them are done early, some of them are done quite late, but it's often too late to go back and easily find this information.
So the key thing is to be talking to your accountants and your auditors and your advisors now, so that you can assess the impact and then see what change it's going to have on how your financial statements look, and have those early conversations with people who use those financial statements.
Absolutely. Thanks, Mark, for joining me today. If you'd like to have any more information about FRS 102, how it's going to affect you or your accounts, please reach out to either myself or Mark or your usual Blick Rothenberg contact.